We have a full practice at the firm in employee benefits, executive compensation, anything to do with employee benefit plans, design, audits, tax questions, planning, estate planning with employee benefits, exec compensation. We'll do compensation studies. We do a lot of compensation studies for nonprofits in terms of intermediate sanctions, reasonable comp, EO 38 for New York State purposes. Even now with the new tax law, which Bob and Magdalena were referring to, there are compensation elements as well. And we also do all types of planning with deferred comp and retirement plans, which we'll talk about in a couple of minutes. So what's happening now? And one of the things I love about my practice is that you never know what's going to come to your desk from 1 hour to the next. So many different and really good questions come up, or scenarios which we have to deal with. So first of all, a husband looking at his investment portfolio turns to his wife and says, "No worries, honey. If we take a late retirement and early death, we'll squeak by." Well, a lot of people say that's absolutely so. So we're in an area now, and I'm sure people have read about this both in the news and other areas, litigation. Litigation on 401k plans, and now coming to 403b plans. Litigation, fiduciary violations, allegations regarding fiduciaries and how they act toward the plan and towards the participants. There have been class actions. What has happened? The plaintiff's bar has found a niche. They look at your organization's 5500s. You have the audits of the 5500s for those that file with 100 participants or more. They're public knowledge. You can get them on the web, either through GuideStar or through the Department of Labor. They review the investment options that are provided either in 401k plans, 403b plans. They convince a group, a class action of participants, that the organization is not acting, or the fiduciaries or the employer or the plan administrator is not acting in the best interest of the participants, as ERISA prescribes and the Internal Revenue Code prescribes they must be doing. Let's start an action. And I'm sure you've been reading in the 401k area and the for-profit area, there have been actions against airlines, against big corporations, and there have been settlements in favor of the plaintiffs. Well, now this is spilled over in the 403b area, and about 20 lawsuits involving 403b plans of higher education institutions, universities, have been filed since August 2016. What are the allegations in these cases? What are major allegations? And major allegations that the organizations or the fiduciaries cause participants to pay excessive record-keeping fees, or that they imprudently offered higher cost investments where lower cost investments were available, the Fund A rather than the Fund C, or they had duplicative investment options, or they provided too many investment options, or they retained historically unperforming funds. The fiduciaries failed to leverage assets to negotiate lower record-keeping fees, or they maintained multiple record keepers, especially in the 403b area, where a lot of times there are multiple record keepers because of historical old 403b investments, whether it's annuities that are still existent in the plan, or the fiduciaries have engaged in prohibited transactions related to excessive fees. Now, what has happened? Some cases have been thrown out. Northwestern University was thrown out, was dismissed. Washington University was dismissed. Brown is still hanging. One case that really was dismissed, that went to trial, and then the university won, just came out, is, anyone know? NYU, down the block. New York University. New York University won the case. It may be appealed, but they won the case. They proved you don't have to necessarily have the lowest funds and the lowest fees and the best investment options. You have to be prudent. That's the important thing, to be prudent. And there were lessons learned by the NYU case, which are very important. Other nonprofits had to settle, and the plaintiffs got some recoveries, as they did in the for-profit area. But some of the areas that were pointed out in the case were records, minutes. The fiduciaries were knowledgeable of ERISA, were knowledgeable of the funds, were knowledgeable of the fees. They met regularly. When they needed investment managers, investment consultants, they put out RFPs. We've helped some of our organizations we provided RFPs and interviewed investment consultants for plans. It protects you. It protects the employer. It protects the fiduciaries of the plan by making sure everything is proper. And at a recent conference I was at, they showed that many more than the nonprofit area, many more plans are now engaging as fiduciaries or co-fiduciaries as defined in ERISA, investment managers, investment consultants, professional fiduciaries, along with the fiduciaries appointed by the employer or from the organization. Make sure you have your minutes, you have quarterly meetings or regular meetings, that the meeting materials are reviewed. Everything is just done in a pro forma way. These 5500s investment information is public, and the lawyers are going after it. So I would advise all of you in your organizations to review your plans and to make sure that the fiduciary setup, the fiduciary structure, it can never be stronger. It can always get more stronger, or it can always get stronger more and more. So keep that in mind, because it is a litigious society out there, and they're looking for these. And as education to participants is being disseminated more, the participants are understanding what hidden fees are, what the different mutual funds are, and so on. So I would advise, if you have any questions on that, please feel free to talk to me later on. Also, another area in plans is many of the plans are now putting in automatic enrollment. I don't know how many of you know. In other words, it's in 403Bs, 401Ks, which many nonprofits are now putting in 401Ks instead of 403Bs. They're almost identical. Automatic enrollment means your participants are automatically in the plan unless you opt out. And that has raised participation in the plan greatly. How many have automatic enrollment? Okay, not enough. But automatic enrollment is an area where it's an incentive for participation by participants, especially if there's a match. If you match a participant's contribution, they're a winner in all ways. How about Roth options? How many of you have put Roth options? Even fewer. Roth options are great, right? They're after tax, but what happens later on? The earnings and at time of distribution, never taxed, right? Don't have to take minimum distributions, required distributions. And if they go into the estate to the beneficiaries aren't taxed. So it's a win-win situation. So whether it's a third-party administrator or a duty of the fiduciaries, these are the techniques that you can do to improve the plan and head off any problems. So when we talk about that, we also have to put a little piece. We have our basic 403B plan, and we have our basic 401K plan. But you have executives. You have executives who need more or higher as part of negotiations, a part of their salary package. Their retirement benefits should be more than just the 18.5 plus the catch-up that goes into the 401K or the 403B. So there are provisions for discriminatory plans, because the 401k and the 403b in general have to be non-discriminatory. Basically all workers or all employees have to be part of those plans. You can have plans that are discriminatory, and we've been seeing this more and more, especially in the 457B area. How many are familiar with 457B? How many have put in 457B for higher compensated or for executives? It's a good deal. It's another 18.5. If you're a governmental agency, then you can put in 18.5 plus the catch-up. If you're pure tax-exempt, it's the 18.5 or whatever that limit is every year. So it's the 403 18.5 plus the 457B 18.5. You must be careful when you do the 457B. It's 100% permissible, and it's a great tool for additional benefits. The IRS is looking at 457B plans. Basically, do you have the plan document? Is it properly executed? Is it following the contribution formula, the participants, and so on? That's one of the areas that the IRS is looking at now. You have 457, you have your 403B, you have your 457B. It's not enough for your executive or for your CEO or C-suite. What are you going to do more for them? Then you go to the next step, 457F, Top Hat Plan. That's even greater, and that's very discriminatory, can be done for anyone, any amount. It's comparable to a non-qualified deferred comp plan in the for-profit section, except there's substantial risks of forfeitures that if you don't work till the time of distribution from those plans, you forfeit everything. But organizations have been putting these plans in to provide greater retirement benefits for their executives. It does run up, possibly, as Bob and Magdalena said, against the $1 million amount. So we have to be very careful, and that's what we're doing with our clients now, evaluating an executive's package, because some of the executives have had these packages for years based on 10-year contracts. Is it going to run up against $1 million in a year of taxability? So I think that's an area you have to look at as well. Tax reform. They talked about tax reform a little before, Bob and Magdalena. Well, we know the tax reform, and as I was at a conference a few weeks ago, and somebody quoted Will Rogers as saying the difference between death and taxes is death doesn't get worse every time Congress meets. Anyway, so we know there have been changes in the tax law for everybody, as Bob and Magdalena said, for businesses, for individuals, for organizations, for corporations, in estate and gifts. So how does it affect us? Well, there's the tax law. That's how simple it is. How does it really affect us? And let's turn it around now. We've been talking all morning about what the CFOs have to do, what the CEOs have to do, what the accounting departments have to do, what the tax departments have to do. Now let's look at our donor base. They're the ones supporting us. How are they affected, and what do we have to do? So the main changes that affect our donors, at least, and you can most probably tell me more changes that affect them, what their real reactions is, yes, the charitable contribution rate for cash contributions has gone up from 50% to 60% of AGI. But look at the other side. Look at the other side. Two examples. The standard deduction has gone up, right, to $14,000. And the estate tax exemption has gone up. So now, if the standard deduction has gone up, why do I have to give? I'm not going to get tax benefit of my charitable contribution. The estate tax exemptions have gone up federally. There are issues in New York State, but federally, why do I have to make a charitable contribution? So where are we? How are we answering those questions? Okay, well, and there was a Lilly study of the forced questions. What will how will it affect giving the most? What will affect giving the most? Will economic growth make up the difference? Won't taxpayers give some of the money they save on their taxes from the reduced rates to charity? How will taxpayers react? And the perceived issues come from different places. The individual giving, bequest giving, corporate giving. That's how all of you are supported. Foundation giving, organization planning. What do we do in light of all this? So what is some of the perceived issues? From the individual point, well, fewer taxpayers are itemizing. Well, that may affect charitable giving, right? They care about, they're going to save taxes, or they're still going to give charity. It's projected through some early studies after the Tax Reform Act, before tax reform, approximately 30% itemized. Now it's projected, and we won't know this for a while, most probably 2-3 years. We won't have all the statistics, that as few as 5% will itemize. So by increasing the standard deduction, it could decrease charitable giving by a lot, between 4.9 and 3.1 billion. Bequests. The estate tax exemption goes up. Will people still make bequests to charity? Studies indicate a reduction from 30 billion to 40 billion per year. It should be 40 billion per year. Corporate giving. Yes, the corporate rates went down, but where's that savings to the corporation going? We read the paper, they're giving employees bonuses, they're raising employees' salaries, they're putting it back in the company. Are they going to give it to the charities? Foundation giving. You get money from foundation, you get grants from foundations. Some people, or it's said that maybe there's, because of continued asset growth, the economy is doing well, that could result, that's a good one, could result in greater grant making. And now for you, the client, the organizations, this is going to affect long-term budget issues, uneven cash flow. Who are your donors? Is it going to be the same base? Do you have to reevaluate your donor base? Do your programs have to be modified because of these changes? These are all things that we, as the client, as the organization, have to look at and evaluate based on what's coming up from our donors, from our supporters. And where did we used to get the money from? Well, let's talk about from plans and IRAs. We'll talk about estates in a second. Maybe not anymore. Maybe not anymore. It's taxable to any distributions are taxable to the beneficiary or to the participant in a plan when they take a distribution. Will they give it to charity? Let's talk about that in a minute. We'll talk about in a minute. Charitable bequests at death. Will that happen again because of the, and here's an example of when you are charitably inclined, when you are, and this is, you can explain for the plan giving people in the audience as well, when you're charitably inclined, when you have a prospect or a donor who's charitably inclined, and he has both assets, IRA assets, qualified plan assets, 403 assets, plus his other assets, his investments and so on. What does he leave to the charity? And what does he leave to his heirs? And basically the answer, the quick answer is, without going through all the problems, is you leave the IRA assets, you leave the plan assets, a 403B. If you want to leave something to a charity, make the charity the beneficiary of the IRA or the plan. Now, make sure they do it. Make sure they do it. They tell you they do it, but you don't know. And the best way is not necessarily through a will. If it's coming from an IRA or from a plan, it should come from the beneficiary designation that your donor fills out as a participant in his company's plan, his or her company's plan. Try to get a copy of it. The number one mistake in all pension and IRA laws, people screw up, pardon me, their beneficiary designations. Make sure it's right. And if a donor comes to you and says, you know, I want to be part of your fancy society and I'm going to get all these benefits being part fancy society, and for that I'm going to leave money to the organization. Ask them to see that beneficiary designation to make sure it's written right, the name of the organization's right, and ask them where it's, who the custodian is as well. That will help you and make sure it comes to fruition. Now, what's happening? In light of the fact that standard deduction is minimizing or possibly minimizing contributions by individuals, how do we deal with it? How do we deal with it? Now, there's been talk about bunching of contributions. So individuals, instead of giving every year, in order to get over the standard deduction, they'll give every second year, every third year, 2 or 3 times their contribution. So they'll get the advantage of both the standard deduction and the charitable deduction. How does that affect you? You don't know when the money's coming. You're going to have no money one year and you're going to have 3 times the next year. So one of the ways we've been talking to our high net worth individuals, and for your benefit, is through donor-advised funds. Why? Because the donor can make a contribution to a donor-advised fund every year, right? Or every third year, every second year, every third year. So he can do it in the year that he bunches. So every third year or every second year, he'll give a lot to the donor-advised fund, which is deductible. And then he can authorize the donor-advised fund to give a certain amount every year to the charity. Got it? So the donor-advised funds have become very popular lately. The statistics show that there used to be two donor-advised funds to every foundation. Now there are four contributions for every contribution to a private foundation. Because this way you can tell your donor, yeah, you can give every 2-3 years and get your deduction. But for our budget purposes, for our planning purposes, for our program purposes, you just tell the donor-advised fund every year to give. So if you give $100,000 every 2 years to the donor-advised fund, the donor-advised fund can give you $50,000 a year, which would be your normal contribution from that person. So the donor-advised fund, most of you know, is a vehicle set up and operated through a public charity to which you can make current deductions, and then you recommend every year to the charity that you want. So it achieves the bunching, you get your deduction, and the organization gets their money. And also, there are many other advantages to donor-advised funds. I know there's some of our clients are donor-advised funds. Some are here who can give us more information. I know Fidelity has, Schwab has. There's the Jewish Communal Fund and the Community Trust Fund, all types of donor-advised funds as well. And there are many advantages to them. One more technique, which I'm sure you've heard, and it's been a stop and go every year. But this is one of those that have been made permanent by the Act, by the new tax law, the qualified charitable distribution. How many of you have heard of that? Qualified charitable distribution. And this is something you should push with your donors. It's very valuable. Actually, it's more valuable than ever before. It's been permanently extended. The problem is it's only good for IRA owners over 70 and a half. You have to be over 70 and a half. But what does it allow that IRA owner to do? It allows the IRA owner to authorize the IRA custodian to make a transfer to your organization directly from the custodian, from the IRA to the organization, and if it does up to $100,000 a year. Now, what are the advantages? Number one, for the 70 and a half person older, it will satisfy, or it may satisfy his required minimum distribution that he has to take out. It's only from IRAs, not from like 401ks or 403bs. number two, the advantage is it doesn't come into income. In other words, it doesn't increase your gross income or your adjusted gross income, and then you would have to take a deduction to give it to the charity, which may be wiped out by a standard deduction. So you're getting the double advantage. You're getting as if there's no increase in your income, and you're getting a deduction in a sense. This is a no-brainer for anybody. You should have publicity materials on this. It's a no-brainer that anyone 70 and a half that wants to give through your IRA automatically, and you can provide all the information and the forms or how to go about it for them to, and make it easy for them. It has to be directly towards the organization. Those that have like checkbook IRAs, it's okay, but nothing in return. No quid pro quo, no tote bags, no pens, no flashlights. You know, just my grandson last night called me. He said, the flashlight you got from the organization last week doesn't work anymore. He says, I need a new one. But and also, you can't give this to a donor advisor fund. It has to go right. They don't qualify, nor do private foundations. It has to go right directly to the charity. And here's some of the provisions that we talked about. It's also good those that have inherited IRAs, in other words, got IRAs as beneficiaries, can also, because you have to take required minimum distributions from those as well, you can also make this qualified distribution. And in the materials, there's also an example. So in general, the qualified charitable distribution is a far more efficient way for 70 and a half, and you have to be 70 and a half. It's not the year you're in 70 and a half, it's you have to be 70 and a half to make the contribution and get the, and finally, bequests, of course. If you're going to make a bequest, as we mentioned before, they're always good. Charitable remainders are still good, but those you have to, the taxpayers understand, the donors understand what's happening, and sometimes these other methods are better, especially in the estate area where bequests are being minimized by the greater deduction. We've read in the papers about the 2.0 tax reform proposals. The House is coming out with some proposals. The Senate refuses to look at them until after the election. There's too much, we know there's too much going on in Washington now. But there are some provisions that will expand charitable deductions and allow the deduction whether or not you itemize. On the other hand, the House bill is making permanent all the changes of the tax bill passed last year. So we don't know where it's all going to end up. The Retirement Enhancement and Savings Act there's a proposal to minimize required minimum distributions. So how's that going to deal with the qualified charitable deduction transfer? We all see this is all tentative as we know, so tentative conclusions. That's all we can make today. Studies show people are primarily motivated to give by their feelings to your organization, and the tax considerations may be secondary. Of course, you have your economics laws. If the cost of something increases, less people will buy it. Many tax provisions we know are expected to expire, but may not, maybe permanent, or some may and some may not. Annual contributions are important, so it may have to be done through bunching and with the help of a DAF, a donor advised fund, or private foundations. From your point of view, you may need multiple budgets or different scenarios, depending on how the funds are coming in, how the contributions are coming in. You may have to now try and get new donors, cultivate young givers, or greater gifts from older people. Look at the estates, look at the IRAs, look at the plans, and try to predict better some donor behavior. So let me read you one thing. A mechanic was removing a cylinder head from the motor of a motorcycle when he spotted a well-known heart surgeon in his shop. The surgeon was there waiting for the service manager to come take a look at his bike. The mechanic shouted across the garage, "Hey, Doc, can I ask you a question?" The surgeon, a bit surprised, walked over to the mechanic working on the motorcycle. The mechanic straightened up, wiped his hands on a rag, and asked, "So, Doc, look at this engine. I open its heart, take the valves out, fix them, put them back, and when I finish, it works just like new. So how come I get such a small salary and you get the really big bucks when you and I are basically doing the same work?" The surgeon paused, smiled, and leaned over and whispered to the mechanic, "Try doing it with the engine running." Thank you very much.